So you think rates are high in the US? Check out Turkey. Look what Turkey just did. Turkey surprised with the bigger than expected interest rate hike to 25%. Why? Well, they have inflation just like us, and it's even worse. So yes, that's what we're going to talk about today, how inflation is impacting the US as well as the whole world, and then what I expect to go on with mortgage rates based on a lot of this data. So my name is Dan Free. I do this report every day to inform you guys what's going on in the markets, especially we focus in on real estate. Guys, I don't know what's going on with home prices because if you live on the West Coast, prices are coming down. If you live in the middle of the country, prices are actually going up. And if you live on the East Coast, it depends. You either are flat or up. So that's what we're going to talk about today. So without further ado, let's get to it. Turkey just increased their rates by 25%. Yes, 25%. Why? Well, because they have inflation just like us, right through here. It's like Turkey's central banks on Thursday hiked interest rates by more than expected to 25%. They were at 17.5%. So if you think our rates are crazy, don't plan on moving to Turkey. So what's going on really behind the scenes with a lot of this stuff? Well, we just had some economic news come in this morning, and it was core durable goods and initial jobless claims. So how might this play an impact on the economy, especially the markets, and especially interest rates? So my first thought is when I look at this, I say core durable goods orders are up. Okay, they were at 0.2. Analysts were expecting it to rise 0.2 again. It raised 0.5. So that means people are ordering bigger items. Okay, so people are continuing to spend, and that's going to freak out the Fed. Okay, another thing is jobless claims. Remember the Federal Reserve, they keep saying we need the jobless market or the unemployment rate to tick up. That means more and more people need to lose their jobs. Well, if you're looking on here, more people didn't lose their jobs. So initial jobless claims came in previous week was 240,000. That number was supposed to come in right at the same pace, and it actually dropped down a little bit, meaning less people got laid off, though there's more people working. So the first thing I'm thinking is, boy, this is not going to be good news for the markets. It might be good news for the stock market because they want a robust economy, people working and everything else. But the problem is the Federal Reserve is saying, well, we need people to lose their jobs, quit spending, so inflation comes down. So let me go over a chart here. So what you're seeing on your screen, I'll get my head out of the way. What you're seeing on the screen is the money supply. This is basically how much money we have as consumers in the bank. It could be checking, savings, just short-term investments that we have access to. This is from the Federal Reserve. So if you guys are saying, Dan, you cherry pick your information, well, I don't, because this is actually from the St. Louis Fed. Okay, so here's what's happening, or here's what happened. Over the last 10, 15 years or so, here's what happens to the people's money, how much people were putting in the bank. So as a country, we were trying to prosper, make things better for us and our families. So we start saving money, and we have a nice little uptick. You see how it's steady. There's just a steady savings pace. Then all of a sudden, what happened? It was like, wham, February of 2020. What happened back in those days? COVID. Well, so how many people lost their job during COVID, but how did this spike up? So let's intensify this just a little bit. We'll go to the 5-year chart. Look at this. Savings rate through here, COVID hits, and then you have wham. So a lot of people didn't lose their jobs, and a lot of people got stimulus checks that didn't need it. That's proven right here, folks. That's not me. I didn't make up these numbers. How else would, when we went down into COVID or when we got locked down in COVID, how else did the money supply that people have in their pockets spike to record levels? Okay, that's what's happened. However, this is where the Federal Reserve, what they're really trying to do. If we dissect what's happened over the last year, where the Federal Reserve has been on a pace of raising rates at the quickest and fastest level ever, look through here. Here's where the M2 money supply is right now. You can see going back a year, here's where we were, and it's steadily declining. So what is causing this? Well, people were just running out of money. COVID stimulus money stopped. This is exactly why people have to go back to work. So when I look at the jobs market, I'm like, okay, I get it. People were gig workers. They had part-time jobs because they had excess money. Now as people are using more and more of their credit cards and they're, depleting their money. Now, I'm not saying people are broke. A lot of people say, well, everybody's running out of money or whatever. Here's where the money supply was. And here's where we are now. It's still substantially higher. So until all of this money gets kind of absorbed or sucked out of the system, we're going to have continuous inflation. Okay, so that's what's behind a lot of this that a lot of people don't understand. The next thing is what's coming up. You're going to hear about a bunch of information about Jackson Hole. What in the world is Jackson Hole? Well, basically, Jackson Hole is where all the bigwigs in banking and finance meet throughout the whole world. Okay, Federal Chairman Powell is going to speak in front of that. Last year when he spoke, he said, guys, we're going to crush the markets. We plan on crushing housing, taking a huge chunk out of the employment numbers. We want to increase rates, and we want to suck money out of the system. Well, what happened was the stock market just took a big tumble. Mortgage rates spiked continually from there. This time might be a little different because Federal Chairman Powell, he's basically, the markets have done a lot of this for him. And you're going to see in the next clip where I'm showing you where mortgage bonds are. And yesterday we had a nice little reprieve in mortgage bonds because I think there's a bubble in the bond market. And I'll explain this in future videos coming up. But Federal Chairman Powell is going to speak in front of Jackson Hole. And I don't think he's going to do a shock and all. I don't think he's going to come in and say, you know what, we plan on skyrocketing rates even more, or 10 more rate hikes coming in. I think he's just going to be on the level of, it's just data dependent. If we start seeing inflation or continuing to decrease as it is now, we might just stay on the sideline. But he has to watch carefully what he says, because if he says, you know, we plan on stop or halting rate increases, the markets are going to look at that saying, okay, we have the direction now, everything can rally. So you're going to see stock markets rally, you're going to see the bond market kind of rally as well, and rates are going to come down. That's what they don't want to do. So they're basically putting their, you know, that master card up their sleeve. They don't want to, you know, go out in mainstream media and basically say, it's kind of where we are right now and we like it. So they're going to be a little hawkish, meaning they're going to say, well, you know, it's still hot out there. The job market still is hot. People are still spending money. Yes, but they're using a lot of the money that they had in savings and they're starting to deplete that. And I think a lot of these systems are starting to work if they would just give it some time. So with this data that we have out that's really dismal today, there's not much out there. What is going on with the markets? Well, this is what's going on. So this is the data I didn't like for today. I don't know how the markets are going to react to this. I thought maybe we'd have a little bit bigger bounce than this or uptick. The reason being is yesterday was a fantastic day. I'm going to show you here next where what happened to rates yesterday. We had a nice rally in this bond market. So what are we looking at on this screen? Well, this is what I see on my screen all day long. Okay, I follow these markets and they say MBS. Okay, what is an MBS? MBS is a mortgage-backed security that trades on Wall Street. It's a bond. Okay, you can buy this. Investors can buy this. The government was buying this. Now they're selling it. But what it is the yield on this thing, this bond, is actually the biggest component of your mortgage rate. Okay, so we follow what's going on with this. What you're seeing right here is what's going on the price of the bond, the price. Okay, as prices go down in this case, so the mortgage-backed security bond is going down. Okay, what does that do to rates? Well, rates go up. There's an inverse or a yin-yang effect. So 13 ticks isn't really going to affect the markets at all today. You're going to need probably at least a 15 tick or 20 tick increase right through here, or drop right through here for it to be really effective in mortgage rates. We had a nice little rally yesterday in the bond market. Here's what happened to mortgage rates. Well, this is what I look at because I really dig into it. But if you scroll down, when you go to this, if you go to Mortgage News Daily, and I have the link down below, this gives you all kind of analysis. Gives you what's going on with Fannie Mae, Freddie Mac, Mortgage Bankers Association. So let's just stay here. This is what happened yesterday with the rates. So you have Mortgage News Daily. Here's where their rates are posted. 30-year fixed right through here, 15-year. Then there's Freddie Mac. So there's different entities out there. If you ever call us or if you ever watch, you know, how mortgage are created, when you apply for a mortgage, it doesn't matter if you apply through me or some other huge bank. We all use the same systems. There's two of them. There's Fannie Mae and Freddie Mac. So they each have their own bonds and their own rates. So right now, Mortgage News Daily, they take a blend throughout the whole country. They say, hey, if you had a borrower that was buying their first house, it was their primary home, and they're a first-time home buyer. Okay, those three things. They have a 740 credit score and they're putting 20% down. What would the rate be? Well, I don't like showing you guys this because it gets a little bit kind of confusing because there's Mortgage News Daily. That's the average rate out there for, you know, basically mortgages when they survey lenders all over the country. Then there's Freddie Mac. That's if you have the ability to if you're a big enough bank, you can go to Freddie Mac directly and get money lent from them. Then you have the Mortgage Bankers Association. I follow the Mortgage News Daily because this is a blend of all the banks, credit unions, lenders out there where the rates are. So that's what's being posted up here. So what you're seeing right here is we had a nice rally in the markets. You're seeing that yesterday mortgage rates dropped. Remember, this is our 52-week high. This is the highest the rates have been. Well, I won't say 52 weeks. I'll say this is the highest rates have been probably in the last couple decades. Okay, so we're off of that level. So you can see we're almost teetering at 7.5 just yesterday or 2 days ago, had a market rally, and you can see across the board rates dropped about 1/8%. So based on this information here, the markets are, I'll say, flat. We'll probably open up right around this area. We might tick to 7.375, which is a little bit lower than where we were, but it was a 52-week high before we broke it 2 days ago. So these are the top 6 products people use when they're buying or refinancing a house. So if you're out there and you're like, Dan, what do you do? Well, I'm a mortgage advisor. I can help people in all 50 states as well as Puerto Rico. How do you reach out to us if you're looking to possibly, let's see if you can get pre-qualified to buy a house. Many areas it's still more affordable, believe it or not, with these rates and these prices, it's still more affordable to buy a house. Or you might say, Dan, I'm just sick of renting. I want to buy into a property. My kids are now in school. I have a solid job. I like where I live. I just want to put my roots down and I want to stay here. Plan on staying here 5, 6, 7 years. So even if we have a little hiccup in the market, we'll be okay. Or you might be thinking, well, I'm buried in debt and I have a ton of equity in my house. I probably get 5 to 6, maybe even 10 applications a day for home equity loans. So if you're out there and you're saying, hey, Dan, can you help me with a home equity loan, trying to get rid of some of these high interest rate credit cards, or maybe you're trying to do some major improvements to the house and you just want to use the equity in the house. So visit our website at therateupdate.com and then scroll down to the bottom and you're going to find our information. Easiest way to get us is give us a call, 844-775-5626, or you can email me right here and I'll answer all your questions. But if you want to just start this transaction on your own, click the Apply Now button. What's going to happen is it's kind of intriguing. You're not actually applying for a loan. You're going to click there and you're going to schedule an appointment with us. Why do we do this? Well, you probably don't know what kind of mortgage you qualify for, what your credit scores are, and what kind of program that fits you into. How much money do you need to put as a down payment? Do you need 20%? You need 5%. You probably in most cases need 3% for a down payment. So these are the things that we can help you with. So please don't disqualify yourself. Please reach out to us to let us help you walk you through this journey. So all you need to do is click that link right there. It'll open up our calendar. You can schedule an appointment with me or one of my mortgage advisors and you'll be on your way. So thank you so much for watching, guys. God bless. I'm going to ask you to do 2 things again today if you would, because it's starting to work. Please, if you haven't subscribed yet, please subscribe to my channel. And if you like this video and you find value in it, all I ask you to do is give me a thumbs up. Thanks so much, guys. Have a fantastic day. See you tomorrow. Bye-bye.